I think the two main arguments were that number one, again, tell me if I'm paraphrasing this wrong. The idea is that wealthy people don't take personal loans, right? So that people who have these high FICO scores, who have a lot of income, aren't out there taking a 12% loan, because a 12% loan is a ton of capital that you're giving back, right? Like you have to pay a ton of interest on that. So that's the first thing. And then the second thing is that delinquencies are rising. We're on our way into a recession. And so during a recession, delinquencies rise a lot. And if you've got a bunch of unsecured personal loans on your books, then you're in trouble, because as those default rates rise, you're going to have to acknowledge those. You're going to have a bunch of charge-offs. It's going to hurt your bottom line. It's going to hurt your top line, et cetera. Those are the kind of the two things that I think that he was trying to get across. So kind of on the first one. So I'm with him in that I would never personally take a personal loan at 12%. That seems bonkers to me. And I'm also, like, between my wife and I, right, we are also SoFi's customers, right? We're kind of there. We fit the mold of what SoFi is looking for in a customer, but that's not how everybody lives. So I think Kris's argument has this false dichotomy where he says you are either fiscally irresponsible and you won't be taking a loan, or you're a high FICO score person and you won't take the loan because you don't want to make a dumb financial decision that costs you 12% interest. There is a giant gray area in the middle with a bunch of people who are living paycheck to paycheck, who are making six figures, but still living paycheck to paycheck because they don't control their spending. And you can obviously see this because SoFi, like you said, they aren't cooking the books, and their quality of borrower is really, really static across time. Like in Q1, the average FICO score on their personal loans was 746. In Q2 it was 748, and Q3 it was again 746. So these are high quality people. They publish in the earnings report, they always talk about how they're the average salary of those people, and it's around $160,000 or $170,000 per year. So these are high earners. But the thing is that just because you're a high earner doesn't mean you're not living paycheck to paycheck. So these people are still going out, they're going to bars, they're going to restaurants, they're traveling, they're going all over the place, they're trying to do all these things, and then they get hit with something that they didn't think of, or they want to do an add-on to their house, or they're putting solar panels on their house, or they realize, oh crap, I've taken a bunch of loans out on my credit card, so my credit cards are overdrawn, and I should consolidate that into a personal loan that has a fixed rate, because every single month my credit card's going up. That's the vast majority of the people who refinance with us. Same thing with Lending Club. So that's why the current rising rate environment is actually a tailwind for personal loans. And they've said this multiple times, and Lending Club says the same thing. They say that this is great as far as personal loans goes, because you can refinance that higher variable rate into a fixed loan. There's this third cohort of people who are looking to make either better financial decisions or have been hit with something that was out of the blue that they didn't expect, and now they need loan. But they have high. So one of the interesting things that Kris Lapointe said this week is he said that they try to originate. They look at a person's free cash flow. It's not necessarily their FICO score that they're looking at when they originate a personal loan. They try to originate to free cash flow. And so you can think of this in the context of like technology stocks right now, right? And he brought this up last week. So Google doesn't need to be laying off 13,000 people. Meta doesn't need to be laying off 13,000 people. They are gap profitable right now. The reason they're doing that is because they're cutting down, right? So if I'm a person who's living paycheck to paycheck, but I'm making $160,000 a month, and now I want to install solar panels on my roof, I can take, a $30,000 personal loan, and now I just go out and I don't drink as much, or I don't, go out to dinner, or I skip one trip to, wherever I was going to go that weekend. You have all this excess free cash flow that you could fill with a personal loan. And that's what they do. So they take something up front to do a renovation or to get their money right by, refinancing all their credit card debt. And the numbers don't lie, right? Like I guess that's the bottom line, is that we know the FICO scores. We know the salaries of these people, right? They're not cooking the books. These things are publicly available. And so those are the type of people who are taking these loans. Now, I wouldn't be one of those people, but there are $6.8 billion of originations who exist from that cohort of people, right? They exist. They're out there. It's not one or the other. There's this entire middle ground.
I was just going to say also there's a definition for as you start to increase with wealth, you increase your expenses, right? Lifestyle inflation, and it happens all the time. Very, very common. I think it's hard, especially whenever doing financial planning and these sorts of things, that anyone would do anything other than the most optimal thing. But it's so true that people get themselves in sticky situations, and even though you have high FICO scores and high income, that you still need debt consolidation.
In regards to what Kris said last week, he is right from the perspective of that's his opinion. And he brings up some very good points. I don't think anybody can say he did not bring up valid points and things that should be considered. Where I would disagree with him would be Kris is very proficient with his capital, and he is probably financially more in tune than many other people. The statement that he said that I'm really having a hard time with was about pulling the money out of a home and taking a home equity line. Not everybody owns a personal residence that's a single family house. Some people own a condominium, some people own a co-op. It is much harder to pull equity out of those two types of properties than an individual home. So there are reasons why people would be unable to pull equity out, or if they had a second mortgage on their personal home and just are not in a position to pull equity out. You never know why somebody needs to take a loan other than they need capital. And it comes down to what options are available to them. But at the end of the day, personal loans exist. Every bank originates them. There's a reason they're out there. And if somebody is going to use it at 12% to pay off something with a higher interest rate, you're saving the spread. So he brings up valid points, but I would like to think that SoFi has some halfway decent actuaries that are building their models. Personally, I'm not too concerned about it, but that doesn't mean there isn't a right to be concerned.
I feel like this comment kind of misses Kris's point. Kris on the screen right now. So he says, so basically SoFi has a bunch of paycheck to paycheck borrows. Kris, isn't your point that you could be making $160,000 a year, but if you're installing solar panels, that's why you take a loan, which is why like you're not living paycheck to paycheck, but you would still take the loan?
So I think these people are living like if you had $30,000, it would make sense to pay for it and install the solar panels with your $30,000 that you have in the bank, rather than initiating a 12% personal loan. I think a lot of the people who probably take personal loans don't have like a big emergency savings fund or other things like that. That would be my impression, but I don't know.
If you look at this, 125 million Americans live paycheck to paycheck. 63% of Americans live paycheck to paycheck as of September 2022. Of those who earn over $100,000 a year, 40% live paycheck to paycheck. Of those who earn between $50,000 and $100,000 per year, 53% live paycheck to paycheck. 21% of U.S. adults struggle to pay their bills. Of those who earn over $100,000 annually, 12% struggle to pay their bills. I mean, these numbers don't paint the greatest financial picture. And these are numbers that many people in the U.S. would classify as a high earner when you start talking about six figures. There is definitely reasons why people would take personal loans. You can speculate all you want about what those reasons are, if it's a good reason or a bad reason, but at the end of the day, every bank has personal loans. They originate personal loans, and this is a business in America.
Yeah, I think it's interesting because when I think of paycheck to paycheck, the mind I get in my head is someone who's, for lack of a better word, like lower income, right? But you could be making $250,000 a year living in Mountain View, California, working at Google, still being paycheck to paycheck because your lifestyle is just a little bit more enhanced, right? And I think that's where you can have the financial flexibility to take a 12% loan because you have this really big salary, even if you are living paycheck to paycheck.
What I'd like to know is how many adults own their residence versus rent. That's what I'd like to know. Because right there, you take out a percentage of Americans that don't have the ability to tap the equity that they've built in their home.
Lending to people where there is a chance at default or a percent that they are expecting to default isn't necessarily a bad business model either, right? That's part of the lending game, is that there will be defaults, right? You look at a company that I used to cover called Go Easy. Look at their financial statements. They cover the highest of the high whenever it comes to risky people in lending. Now, they charge an interest rate to go along with that. I mean, 40% interest rates on their clients. Now, everyone thought they were going to go out of business whenever COVID hit, and then now, and they have.
But Tanner, why is that a good business if they default? Why is that a good business?
Hey, Kris,
no, I'm
check
not
the
saying
private
it's
math.
good that they default. I'm saying it doesn't, like, if their interest rates are set to a point where they can pay for the losses, then that doesn't mean that it's a bad business model. They are expecting losses.
Gotcha.
I'm
It's
not
almost
saying
like Target
losses. I'm
expects
saying
people
that it's part of the expected lending game. And the same with the idea of unsecured versus secured loans, is that if we have secured loans, then the interest rates are going to be lower. And if we have unsecured loans, then the interest rates are going to be higher to pay for the people that default. And so this is all part of the game. Whether you say that we're going into impending doom is kind of like an indefensible argument because it's just someone's opinion.
While you're
I
doing
disagree,
that, I
Nathan.
can echo what Tanner's saying. It's kind of like Walmart or Target expecting people to steal from their stores. And they kind of have to bake that cost in, right? 'Cause
Exactly.
They know they're going to sell so much. Some people are going to steal.
And
Let me
I'll
just let
probably
me
share.
bring in Kris now because he's here. This is the man who left his spooning with his wife to come make
Guys.
this argument.
Yeah, no, he should be
I think
here.
he's here.
Yeah, Tanner explained it pretty well. I was actually listening with regards to defaults going higher, right? Basically, that was one of the things that I was trying to show everyone, which is right now we're not nearly in the recessionary environment that we were in the past. And in the past, when the recessions usually hit, you're going to see delinquencies, pretty much go up. Now, the thing is, if you take your loans, take them off the balance sheet by securitizing them and everything else, that's risk that's not on your balance sheet, right? Whereas right now, SoFi has a lot of stuff on their balance sheet. They have a lot of personal loans on their balance sheet. So basically what happens is the interest income that they get for those loans, they use that. And then all the non-performing loans, they have to subtract against that. So basically, if let's say someone doesn't pay for 90 days, guess what? That's a non-performing loan. So what are you going to do with it? You're going to keep it on your balance sheet saying, oh, this is a non-performing loan? No, you usually have to take a write down. Now, the thing is, the more people that don't pay ends up being really bad thing for SoFi, because now it just digs into what's happening to them. On top of it, the cost to borrow capital is steadily rising also, right? So if you look at like
So what, Kris, can we get into your response? What was your issue with what Kris Heugermeister said?
This is the chart you showed last week, right? You know this one.
Mhm.
So this is from TransUnion. It's their data. So for personal loans that are originated in the third quarter of 2007, this is how many of those defaulted. So you're right in that defaults were increasing across the board, but they're decreasing significantly more in the subprime area than in the prime plus. So SoFi's originations are 746 is their FICO score, which is right in the middle of prime plus. So this is like the absolute worst part of what we're looking at here between 2007 and 2010, and the like when delinquencies went up. But the type of loan that SoFi originates is a prime plus loan, which means over 3 years. So between 2000, this same cohort, so all these loans that were originated across all banks from in the third quarter of 2007, only 1% of them had defaulted by the third quarter of 2010.
So, Kris, I'm totally with you on that. My question is this: how many prime borrowers are borrowing at the rate that's out there right now? Like, think about it this way logically. Like you just said, okay, listen, I would never borrow at a 12% interest rate, right? Because you're somewhat financially savvy, you know what's going on. Most prime borrowers that I know, they're at least somewhat financially literate to know that, hey, you shouldn't be paying double digits for a loan, a personal loan. I mean, yes, I get it. The argument is, well, you know what? There's a lot of Americans that live paycheck to paycheck. Well, guess what? They're probably the least likely that you want to borrow money into during a recession because they have no emergency funds. You guys said it yourselves. They are probably the most likely to default in case something bad happens. So yeah, I get it. The credit cards and all this other stuff that they're doing, credit card consolidations and everything else, but that doesn't erase the debt. That just makes things, that gives them additional lifeline for like another 6 months, 7 months, whatever, especially if you lose your job and you've had high income. Like, it's really hard to figure out where you're going to end up being able to financially support that. So my thing is, I don't necessarily trust that a lot of the borrowers that they're saying that are prime. And I'll tell you why. If you go to 2017, and this is something that I'll show you guys here. Let me share the screen.
So can I answer that real quick? The argument you just made would also have held true in 2007. So these high prime plus borrowers in 2007 would have exactly fit the description of what you described, the high FICO borrowers in 2020.
There.
But in 2017, they weren't underwriting to the same quality of borrower. It
No,
was under
they
the
were.
previous CEO.
Dude, I'm telling you right now, back then they used the same argument that, hey, listen, we have wealthy borrowers. They have all good FICO scores. It was the same exact argument that they're making today. Everything that they're saying, like, oh, we have high FICO score borrowers. We have, wealthy individuals that we're lending money to. Well, guess what? Wealth means that you actually have assets that you can actually borrow against. So once again, people with a lot of assets, They're not the type of people that are like, oh yeah, let me go take out a high interest loan. They have
But they are.
sources.
That's the
They can,
point. Like SoFi's not cooking their books. They have people who have
and I'm not,
salaries of $160,000 and
and
FICO
I'm,
scores of 746. Like
uh,
you can't dispute that. And
Yeah.
those
no,
are
and
people who
you're
have been
totally
paying their bills, who have like you don't just get a 750 FICO score because you're defaulting all over the place, right?
Chris.
And
I understand that, but guess what? That's at the time of origination,
and
right?
so
Of these
was the
things.
data I just showed. That's my point.
Mhm.
That
Right. That,
2007 data
mhm.
was at the time of origination.
Right.
And 3 years later, though the
Mhm.
exact type of person that you're describing. So
Mhm.
the people who are taking out personal loans, who have these unsecured personal loans, who
Mhm.
are at such a high risk of defaulting, only 1% of them had defaulted.
But I'm still telling
And
you that
that's not
there's,
my
yeah,
data. That's
yeah.
TransUnion's data.
If we are going to go into a recession that is going to be worse or mild than '08, nobody can speculate that. I mean, we'll know in a year from now, a year and a half from now. So anything can happen. On the other side, the data that Angel Chris has provided for the SoFi
I
fans
prefer Jedi, Chris.
is Jedi Chris, sure, we'll stick with the Star Wars theme, has shown what happened in the financial crisis. We're going to have to see how it plays out. I would once again like to think that SoFi has actuaries that built this into a model. And based on the model their actuaries created, the loans that they are originating fall within their profile of risk.
I don't think you can say people aren't buying these loans and also they're not cooking the books. More and more people every single quarter are taking our loans. And if you do trust the 10 Qs, then they are 160,000 plus incomes and do have those FICO scores. So if those people do not take those personal loans, then our 10Q is wrong. You know, it can't be both.
Hold on.
Unfortunately, one of the times I think that I don't know if there is a way to dig into the bonds and the debt, the personal loans that they have. All right. Like I don't know if there's a way that we can actually go in and figure out what SoFi's personal loans on, what the credit, like them just saying, oh, we have high income borrowers. This is the average, this is the average FICO score, all that stuff. That's great. I agree with you. But guess what? I wish there was a way that we can actually look at that and see what the borrowers are, what their incomes are, what kind of debt that they have, what kind of debt limits that. Like, if you guys remember in The Big Short, like when they was like, okay, let's go and see if there's actually a housing bubble, because whenever you get into the situation of this dogma that, oh, this can never be wrong, like everything is perfect, this is a AAA rated bond, everything is fine, that's when you really have to be a little bit skeptical and say, you know what, do I trust these guys? And I right now am not saying that they're cooking the books at all.
Thank you.
But what I'm trying to say is I don't trust the numbers as much as that, because it's just it's unfathomable for me that you're running a business, right, that isn't impacted by higher rates at such a high velocity. And the fact that all of these loans are staying on the books is a bad sign, because that means that investors are saying, wait, hold on a second. I don't want your loans that you originated. Take them back, right? And that's the same thing with Lending Club. At least Lending Club is, keeping money on the side in case of these defaults. SoFi isn't doing that. They're keeping all of this on hold for sale. That's the problem. Why aren't they provisioning some capital or some cash for delinquencies? That's the question that I'm really puzzled by.
So here we go. The reason you can either choose hold for investment accounting or hold for sale investing. The reason that SoFi chooses hold for sale accounting is because they don't hold to maturity. Like it's pretty binary. You can choose what you do. This is the loan maturity schedule from the last 10Q. So we have, like it shows here, so this is in originations, not fair value. So it's not exactly what you'd see on the balance sheet in terms of the total that you see on the right. But they've originated about $6.7 billion worth of personal loans. Of that $6.7 billion of personal loans, only 100 million of it, or less than 2%, is due in the next year. Student loans, it's even more clear. They have $3.9 billion of loans and only 7 million of it. So it's like 0.02% of their loans go to maturity in the next year. Is that the reason that they do hold for sale is because they're going to sell these loans. So SoFi, at the rate they're originating, so they're originating $2.8 billion per quarter. At that rate of origination, they will cycle all of these loans in about 7 months or 8 months. So they cannot hold
Mhm.
them on the books longer than 7 or 8 months. Now, the reason that they're extending the holding period, we'll get to that in a second, but it's the same thing with student loans. So student loans, they're cycling about once a year. The reason that they're using this hold for sale accounting is because they're like 98% plus of their loans are going to be sold. So that's why they use it. Unlike Lending Club, who has this hold for investment model and it purposefully sells those loans. Now the second question is, are they actually going to be able to sell those loans, right? The thing that SoFi has going for it is a couple of different things. So number one, so this is the only securitization that they've done in the whole last year. And this
Wait,
came
before
on
you continue, I just want to ask one thing.
November. Yeah, go
Even
ahead.
though that says 440, how much was that for?
This is 440 million.
No, I think it was something like 660 million or something.
Right, but here's the thing. So this is the weirdness that comes around, okay? Even though the face value is almost 600, they have to place this giant buffer in the middle so that this way investors feel comfortable enough. This is like a way to get a AAA rating that's, I hate to say this, but kind of weird, right? Like this is the same thing that was happening with the bonds when the mortgage-backed securities, where if you remember the Django thing that, what's the name, that they showed, that this entire thing wasn't just full of all AAA rated mortgage bonds. It was full of some double Bs, some double A, some A, some double Bs. That's what I'm seeing right now. That because of the diversification, they're getting a AAA rating. But I don't think that this is a AAA bond. I really don't.
Do you think
But
the
that's
large do you think the
Go ahead.
large discount just simply comes because, you know, we're getting a full payment of 440 million instead of waiting the 15-year terms that it could be across the loans? Like there has to be a large discount because we're not waiting out the terms.
No, I think that there's an inherent risk with this bond. That's why you're getting such a big discount. You're basically taking, like SoFi is taking most of the risk in this. Look at the tranches. Open it up, look at the tranches on which they have different things, right? And see which tranches SoFi has to cover by itself in terms of risk. Because that's what's going to happen. This is something that's like a waterfall where AAAs are going to get, like in the mortgage bond, the AAAs are going to get paid first, and then it's going to go so on and so forth, with SoFi being at the bottom of that. The fact that they have to give such a big discount, and not to mention, just look up the other securitizations they've done earlier, about a year or 2 years ago, and see what kind of buffer that they had back then, because it's nowhere near the buffer that they had to provide for this securitization.
But the reason for, well, part of that is also that they don't securitize things anymore because they sell wholesale loans. So they sell to wholesale buyers instead of that. That's the reason that this is the first securitization this year, is because they don't use the ABS market very often.
The fact that you have to provide almost a quarter of the bond as a buffer is not a good sign. That's all I'm saying. I'm just saying, be skeptical. All right. That's all
I am skeptical, and I have gone through most of the filings, and we don't have time to do that on the podcast.
And Kris, you can look at the filing and see the growth of those personal loans also that they have on their balance sheet. It went
I definitely have.
Yeah, it went from 2 billion to 6. It was like, whoa, what the hell? And it's in less than 6 months. That's the other problem. Like, I could understand if it was a much longer period, but it was a very short period where all of this stuff came around. So,
hey, but here's,
mm-hmm.
Can I answer that real quick?
Yeah, go for it. Yeah.
The thing is that, so in first quarter of 2022 is when they got the bank charter. And at that point, they said, hey, we're going to extend our holding period from 3 to 4 months to 6 to 7 months. And when they did that, they had about $6 billion of loans on the books. So if you just said, okay, if you're extending that from 3 to 4 months to 6 to 7 months, you're going to go from only having $6 billion on the books to $12 billion on the books. That's pretty easy, right? Because you're doubling the length of holding time. And then if you say, okay, so I'm starting at $6 billion in first quarter, I started originating everything in the bank in May. So even though they got the bank charter in February, they weren't originating all loans until May in the bank. And then you're going to build your balance sheet for the next 6 months. By the time you get to parity, it's 6 to 7 months later, which is November or December before they get to parity. And if you just draw a line and you say, well, if I'm going to start at $6 billion and I'm going to end at $12 billion because I'm doubling my holding times, then right now you'd be at about $10 billion of loans on the balance sheet, which is exactly where they are. So they forecasted the exact amount that they were going to extend their loans by, and we're right in line with that number. Again, I do want to stress that there is risk in that. So let's say we get to the first quarter of 2023 or the second quarter of 2023, and there's not enough demand for their loans from debt investors. They can originate loans up into a point and then they have to sell it. And if they continue to originate loans at the same rate and they're not offloading them off the balance sheet at the right rate, eventually they'll get to the point where they're capital constrained. They're not there yet, and they still have a ways to go. And the part of this whole thesis that I don't feel that I know really well, because I have no special insight into whether or not the investors, like debt investors, so JP Morgan and hedge funds and these other people who are buying these personal loans, if SoFi comes up and says, we're going to sell these loans, and they say, no, I'm backing off. Now, they are insulated against that because they have, if you're going to buy an Upstart loan or a Lending Club loan or a SoFi loan, you're going to buy a SoFi loan because they're way higher quality than the other ones. So, I mean, that to me is the biggest bear case. The problem is that I don't really know, and it's really difficult to tell until we get first quarter of 2023 numbers. It will be impossible to tell how much demand there is. I think it was a good thing that these loans, these $440 million of loans, like they sold in 3 days. Like it was really quick. And there's loans that have been, on the ABS market for 3-4 months that haven't sold.
And that's something that I wanted to add as well, is that saying that, there's a large buffer in our ABS market or what we're actually selling or what we're discounting for that sale, that's a fair statement, but what is it against? Like, is this a larger buffer than what else is on the market? And do we know that? What's the average based on the actual yield that we're offering in the, the terms of the loans versus what we're actually offering? So saying that it's extra risky is just going up against what SoFi has to say, because obviously the same people that are offering these loans are also expecting losses from those loans. Are you expecting larger than what they're expecting? And is that larger than what the total market is suggesting? Because if it's one person's word versus another at that point, if it's to say that it's riskier without saying that the competitors don't have better rates than us.
Well, look, you have to go by the information that's given, and anything else is pure speculation.
Right.
Especially when you start talking about it being AAA, but maybe there are other things in there and it just has such a wide variety that's classified as AAA, like what happened back in 2008. It's very hard to come up with that answer. So I think we have to go with what they are saying, and you can be as skeptical as you want. And Kris brings up a very good point, and it's a great bear case as to why people should really take that into consideration, because it's a risk, especially if even half of what comes true that people are speculating for 2023 and 2024. It's a concern. But at the end of the day, given the data that we have to go on based on what happened in 2008 through 2010, it's not as bad, my opinion, as what it seems like. And I'm personally willing to take the risk because I look at this as a very long-term investment, and it's either SoFi's going under or they're not going under. I'm not selling this in 6 weeks or next year, and my investment is on 2030, not 2023. I'm operating that student loans aren't coming back in 2023. I don't care at this point. If SoFi doesn't go under, I would say the chances that they're going to do pretty well is pretty good, but you're going to have to wait a couple of years. So do you want to lock up your capital for a couple of years? For me, I do, because I think the juice is worth the squeeze. But everybody has to make that own decision for themselves.
Kris, you're not shorting the stock, right?
No, I'm not.
Okay,
It's so down. And dude, this is the one thing about investing that people have to realize. One thing goes right and in their favor, this thing could skyrocket tomorrow. Okay. Yep. That's the key. When you have something that's super undervalued, and like I said, my theory could be completely wrong. Don't say, oh, Kris Petal, he's absolutely right. He's the smartest guy on the planet, so I'm not going to invest in SoFi. Clearly, don't do that. Like, if you believe that this company is telling the truth, by all means, go right ahead. And if their business model works, a guy like Anthony Noto, who I'm telling you, this guy is buying a ton of shares. That is a very, very good sign. No one that's predicting a company is going bankrupt is like not buying their own. Like, CEOs buying shares of their own company is a very healthy sign. That is the biggest form of shareholder alignment that you could possibly get, right? So I would say that in all possibilities, I could be 100% wrong, but be skeptical, because I also could be right. And if I'm right, things can get worse very bad, very quickly. So all I'm saying is temper your expectations, right? As investors, we all need to temper our expectations. So what can be possible, but also what can go down.
SoFi has been through trial by fire right now. They've been operating with their largest business segment that was cut in half and operating under half mast for part of the past 2 years. And this is a company that faced a ton of adversity and when put to the test, had to, and I repeat, absolutely had to diversify their revenue streams and built out all these other lines of revenue to where student loan moratorium doesn't even impact them now. That's why I'm looking past 2023 because they're going to keep building. And when that line of business actually does come back, if they're not out of business, which I don't think they're going to be, I think we can see something very special down the road in the back half of the 2020s.